How's everybody doing? In this video, I'll be going over how I cover my risk. Disclaimer, this is how I cover my trading bag risk. How I hedge my spot bags is completely different. And before we move forward, I'm going to explain to you how I plan my trades and how I manage my trades so you have a better understanding on why I hedge/cover my risk this way. So how I treat my trading bag is pretty simple. For this example, let's do an account size of $1,000. Let's say I got an account size of $1,000. I will usually divide that to like 10 lives, which would give me 10 trades pretty much. Each trade is max $100 I could risk per each trade. And of course, if you've been following me, I enter my trades using the 20, 20, 20, 40 method, pretty much breaking up this $100 into 5 entries. Pretty much 3 entries is going to be $20 each. On the last one is going to be $40, just to make it simple, okay? This example, I'll be showing you how to cover risk on a long, and since we are going with a long, I'm pretty much favoring price to go to the upside in the longer term, right? So my shorts, since I'll be hedging the long, I'll be taking profits much sooner and getting in and out of the shorts for this hedge much sooner than my long position. Hope that makes sense. I forgot to say this, but on the hedge, I'll be risking the same amount. So if I'm risking $100 on the long, then I'll be risking $100 on the short, okay? And the goal of the hedge is to pretty much be able to take profit without having to take profit on our longs. Since we're favoring longs on the longer term, I want to keep that position bigger than just keep on taking profit. So when we add on the pullback, it doesn't mess up our entry as bad as if we took profits and then added again. Then our entry would be much higher than if we did not take profit and we added with the same entry position size. It will bring it up just a little bit plus a bigger position. For the profits on the short, then I would psychologically see it as profits on the long. So whenever I start to de-risk or put my stop to entry, it's not like if I get stopped out, I break even. At least I had some type of profit rather than just making nothing. I want to show you this example in my personal journal on Notion, how I use it and implement it on my trading. So right here on March 3rd, this was the position I got in. And then I didn't start looking for a hedge until I think March 6th, which this is how it looked once I decided to do that hedge. And I'm gonna go over how the thought process and why I did this hedge and how I calculated to my long also. This is ETH. Let's go back to March 3rd to see where that position started and how everything played out. This was the position on March 3rd, right? And then on March 6th was when I decided to do the hedge. So let's see once we hit March 6th. Okay, I decided to do the hedge on 21.25. Of course, I didn't update my journal as soon as it happened, but 21.25, that means I shorted right here on this retrace back up. 21.25 right here. This was my hedge short, right? And again, the reason why I did this was because I only had in this position my first 20%. Since I'm looking to build my long and it's looking like we got a topping structure and was going to start moving lower, instead of taking profit or bringing this to break even, since I'm already expecting to build this trade, because if this is a $100 trade, if this is a max $100 risk, that means my first 20% is $20. I'm already planning to add another 20 here, and then save my last 40 for a quick sweep under. That's already the plan. But instead of getting out of the trade, because there's been a lot of times previously in my trades where I would just say, okay, I'll just break even and wait till I get lower, and then I miss it, and then we completely just move out of here rather than just being in drawdown. This really helps you actually to be okay in drawdown, okay? But so this is why I took this hedge, because we were getting close to entry. Price was looking weak. I was like, you know what? It wouldn't hurt to put 20% of, since I put my 20% along, 20% here. Especially if we're in profits, it's better to add or start hedging when your long trade is already in profits. If you are trying to hedge when we're already in drawdown, that's when I wouldn't do the 20% fully. I want to kind of get it close to the position size of this long. So whenever it goes down, and let's say, God forbid, we go to our stop loss, now that will cover some of that stop loss, okay? But that is why I got into this hedge for this ETH trade, because I saw this weakness and I was like, if I'm anticipating we might go down for that higher low to go higher, I want to take advantage of this drawdown. Instead of taking profit here, I put a 20% hedge trade compared to my long, and I'll take profit down here. That would be a 8% gain. So now I take that profit I made from that trade and put it into my long. So now, like, if I get stopped out mentally, psychologically, I saved $8 from that loss. Now you're seeing where it's going. And then if it's a profit, if we don't go to my stop loss and we keep going higher, then as I'm taking profits along the way, I have an extra $8. So it helps me on my psyche. This is why I do it this way. Go back to my journal. I said, took profit on the short, look to hedge at the POC above, pretty much meaning here, I took profit here. If we come back here and look weakness, look to add to this hedge again. Because remember, I didn't take full profit of this hedge. I took like 25%. So I took 25%, gain a little bit of profit. If we start going back here, add again to my hedge and we see weakness. So that was a quick example how I use it and how I implement it in my trading style. Of course, if I was hedging a short trade, as in looking for longs, then I'll do the same method, but reverse. So now the profit on the longs, I'll be taking profit much more on those, and now psychologically seeing that profit as the profit into my short. Obviously right now I am mostly long, because if you watch my previous video about Bitcoin, and the crypto market in general, I still believe we're going to get that rally because we are overextended to the downside. If you want to know my thesis on why, then you could look back before to get my thesis. But same thing for if you are looking to de-risk a short. And you might be wondering, what if I'm wrong? What if the hedge is wrong, right? Then what you would do is, since we're favoring longs in this example, then you would take the percentage, like maybe 50 or 75% profit on that long, where it covers your loss on the hedge and maybe a little bit of profits on top. And this kind of goes into my thesis of gaining in small wins or gaining in small losses. And this is a quick example on this hype trade that I have currently, where it's likely going to hit my liquidation price, and how I structured it so whenever it does hit, I'm still going to get a win either way, and why that this is beneficial for me. So on this hype short trade, you see it's like really shitty entry, really bad trade, but this is actually a hedge for my hype long, right? $46 is the liquidation for this short trade, but when we go to my hype long, this is the position. It's at 35 now because I added, but it's to the EMA, right? When we go to Mexi, you can see my long and short trade entry are pretty much at the same price, and here's my short liquidation level. As you can see, I already been locking in profits on the way down, right? So the reason why I wouldn't close this short is because there's a possibility we might come down here and come touch these EMAs, where I'll probably take profit on the short. But just so I could guarantee something, even if I get out here, because this would be my new invalidation for my long, the profits of this would have covered it to at least break even or to a little bit of profit. But for example, since it's more than likely we're gonna come take out that short trade, my profit right here would $77 would cover my loss right here at 55. So then I will gain a extra $22, like I said in my journal entry. And if you're wondering why I'm doing it this way, it's because it's easier to add to winning trades. I lock in profits, guarantee, and if it goes against me and it goes against to the original position, which would be my long, which will be the heaviest position, because one of the positions has to be heavier than the other to cover the loss of the other to guarantee a small profit. If we go first to my long, then the profit on the short won't be enough to cover my loss on my long. But that would, instead of losing $50, now I only lose $10, $12. So you can see how it keeps me in the game much longer, and it keeps me in the game much longer. And I believe a really good pro about covering risk this way is that for a beginner trader that's still learning, not only does it keep you in the game longer, but it also makes you focus on both sides of the trade, especially when you have real capital at risk. At least in my experience, when I have real capital than demo trading, I focus a lot more on price, because that's real money that I could potentially lose. So now if you have trades on going both direction, you're almost at the same time training your eyes how to do both. And of course, the most optimal place to take a hedge is when your original position is in profit. When I first started doing my covering risk this way, I will be mostly hedging when I'm already in drawdown, which that's not the place you want to be at, right? But since I had to learn that way, and I was at the end of the day, I was still on my losses on my longs, I was still not losing as much, keeping me longer in the game. And as you get better as a trader, now instead of you hedging in losses, it becomes where now you're always in profit when you're hedging. And that's the best place to be at. If you're always hedging when you're in profit, then it's almost impossible to not gain some type of profit. So doing it this way, it's not as exciting because you will take losses, but if you do it correctly, the hedge won't be as much as the original position. So you will always gain something. Okay, and even if you're wrong in your original heavier position, as in the long in this example, then even when it takes out the long, you're not losing most of the position. You're gaining most of it back to re-enter lower or to reevaluate. If I had to give a con about covering risk this way, at least in my experience, I've been covering risk this way for a good amount of months now, maybe for a full year, is that the gains are slow. It's slow. But if you're in it for the long run and not trying to gain those quick profits all the time, then this is, I believe, this system that I'm using is going to keep me in the game forever. Now I'm going to be showing an example how I would have been trading this range on Bitcoin and using that same risk covering strategy. Of course, it's on hindsight, so I'm going to try my best to kind of show you along the way the process and how you could have positioned yourself without seeing any of this. Okay, first things first is to find the range, and of course when this range got confirmed, it was right here. And if you're wondering why this is the new confirmed range, oops, let me go back, sorry. And if you're wondering why this would be a confirmed range, is because when we zoom out, we had an obviously breakdown. This was the down retrace continuation, and move down, move up, this is an obvious low, and now a move up, a move down, this is that high. Going back into Bitcoin, if you remember, I treat each position like I know how much I'm going to risk. So in this example, we're going to do the 100 for the long, right? And then for the hedge, I'm going to risk the same, another 100. So to make it very simple, obviously when we hit premium, start buying 20% for 20%. Since we're favoring to the upside, I'm going to be going a little bit heavier on the entries. And once we hit the premium, that's when you start your hedge, okay? So for example, let's say price is going, right? We don't buy until we hit premium, discount. So then you would add your first 20% right here. Now your first long position, be right here. And the closer we get into premium, especially above this line, then you could add the 20% on the hedge. We hit the zone of the hedge. You will put 20% of your hedge for this long. So now both these positions, let's say for the sake of example, both these positions we're doing like a 5x. So what, this is like a $100, and now there's a $100 position too also. And when we hit the 50%, which is we are entering our long, we could decide to either take profit fully or take profit partially, because we are favoring the upside. So remember what I said before, since we're favoring and hedging this long, we will be more aggressive on the profit taking on the shorts, because we're just trying to gain as much profit for this position. Okay, so right here I would take like 25% or something off, right? And you would take that and save the rest for down low. And also if we start seeing support here, like if I saw this break of structure, since I already got some profit out of this, I would probably add into my long right here another 20%. Another 20%. So now we would have added here, and now we're adding here to our long, which already taking profit on our short. Okay. Now, since the market structure is different, now I know that if we lose this, I should add to my short because it's likely we're going to go down lower. But now we go to the premium section and we start seeing M formations or any weaknesses, we could start adding back into our short. Okay, now this is why I don't go in with the full position. Now, and this is why I never close a position fully, and I rather just let it get liquidated. Okay. Now, since I already took 25%, I would take another 25%, gaining more profit here. Yes, these two are underwater, but now those profits I'm getting from this short is going to be, I'm going to see it as like the, what do you say? I'll be seeing it as this is the risk covering for the long. So let's say I gain like $10, $20 here. I only have $20 in the long position and another 20, I have $40. So now I gained, for the sake of example, I gained like $10 max. So now technically, even if these two positions, if I don't add anymore, if I just want to see how price is developing, if it goes down to my stop, then I would have saved those $10. But let's see how price keeps going. Same thing, now that we're back in profit. Now, I just want you to kind of see how it gives you a lot of opportunity to manage price. If you don't close these trades, since I'm favoring heavier on the long, you're forced to keep on paying attention to price action all the time. And like the same thing right here, like let's say we're seeing like, oh, hi, we're going lower, we're going lower. Okay, we had a break of structure here. You would add it to your short. And here's the thing, even if you're, this is why I like this, because if you're like, fuck, I don't know if I want to add, we're going up. One rule is that if you're not sure, just look to your left. Where are we? If you're in premium and if you're looking for shorts, just add a little bit, going light. But I hope you see, but the whole time when I'm doing this, I'm calculating based on my position. My short is not going to be heavier than my long unless I see clear confirmation we're going down lower. And then when I have clear confirmation, then that's when I put a stop. I usually tend to let my positions hit liquidation, but that's just how I do it. Okay, but this is why I'm saying that even though I'm never gonna close my short, and eventually it's gonna hit my liquidation price. I've already been taking profit on the short and on the longs along the way. Where this short, once it gets liquidated, it will be covered. And also, when I add into it, if I see weakness up here, then it will bring up my position up higher. And also, another thing that I've been noticing some exchanges, when there's low funding, sometimes it pays you to have these positions open. I had one position that I had open for a long time, short, and it was giving me like, by the end of it, before it closed, I gained $5 in just funding without even just having it open. So this is why I do it this way, because it forces you to pay attention and to always look at the both sides. Also, once you are in a position, kind of like my hype trade, where one is gonna get hit either in the other, I stop adding to it. Even though I only have $55 in and my position I'm trying to risk is $100, I just leave it alone, because to me that's a free trade, and I'd rather just look for another one. I hope all that makes sense. If you have any questions, please comment down below and I'll revise the video or make it again. But the reason why I wanted to bring out this video is because since I'm going to be doing more content about news and what I'm anticipating, and I might be saying to the public, I'm going to be looking for a buy here, long here, it's going to incentivize you guys to want to get in also. And I want to give you guys more of a disclaimer on how I could eat this loss, because there's going to be times where I'm going to be like recently with my gold trade, it dumped down astronomically. I had a little hedge in play, it covered some of my losses, but this is how I could afford to be wrong. So it's like a little disclaimer to show you guys that, hey, I'm not just talking out my ass, I'm actually doing everything that I'm saying, right? And showing the proof on how I'm doing it, and not just saying it and showing you like examples of it like in hindsight, right? But I hope this was informative and kind of give you an idea on how to hedge maybe your swing trades or whatever. You don't have to do it this way. The cons of covering your risk this way is that it's not good for small account sizes. I do this with a trading bag of like 5,000 and up, where I could risk 500 to 1,000 per position, where when I'm in positions like the hype trade, where it's a matter of time where I'm either gonna get that $22 profit or whatever else. This was recently built, but once I have something built, it's worth it on the wait. You know, it's not just like, oh, I waited 3 weeks for $20 gain, right? I do think this method of covering risk is going to be really good for newer people, just so it incentivizes you to pay attention and to look at both ways. And the more market experience you have, the better. You could read as many books as you want, you could watch as many videos as you want, but as long as you're not risking actual capital and doing real trade management, it's not going to, that reading and watching videos is not going to correlate. Just like in anything in life, if you're going to be a doctor, mechanic, you could read all the books you can in the world, but as long as you have hands-on experience, it's not going to be the same. And this is going to force you to get that hands-on experience. In the beginning, almost all my hedges were in drawdown, which is, that is not the way you want to do. That is you doing this type of strategy bad. The most optimal is always hedging when you're in profit, right? But as I'm getting better as a trader, now my entries are getting better and better and better. Now where every time I hedge, I'm always in profit. But I hope you guys enjoyed. I hope all that makes sense, and I hope you understand better on whenever I'm talking about how I'm covering my risk and how I could afford to be wrong sometimes. But I hope you enjoyed, and I'll see you guys on the next one.